Welcome to Asset Classes and Financial Instruments. In this module, we will move from broad categories to the specific contracts investors use. We will examine money market instruments, bonds, equity securities, market indexes, options, and futures. Along the way, we will update several conventions that have changed since the original chapter, including today's Treasury bill terms and the transition from LIBOR to SOFR. The slides are intentionally concise and visual. The narration provides the explanation, while worked examples show how quoted yields, tax treatment, index construction, and derivative payoffs affect investment decisions. Suppose you have $10,000 available today. The amount is the same, but the job may be very different. An emergency reserve emphasizes liquidity and preservation of principal. A 5-year income goal emphasizes contractual payments and maturity. A retirement goal can tolerate more short-term variability in exchange for long-run growth. A future fuel expense may call for a hedge rather than a conventional investment. This is the organizing idea for the chapter. Do not begin with a product name. Begin with the required cash flow pattern, time horizon, risk capacity, liquidity, and tax treatment. This module has 5 outcomes. First, you should be able to classify major financial instruments by asset class. Second, you should be able to compare contracts using practical dimensions such as issuer, maturity, cash flow, liquidity, credit risk, and tax treatment. Third, you should be able to calculate and interpret several yield conventions, including the tax equivalent yield for municipal bonds. Fourth, you should be able to explain why different index weighting rules produce different results. Finally, you should be able to distinguish options from futures and explain how derivatives can be used either to manage an existing risk or to take a new one. The chapter is organized around 5 questions. First, what job must the instrument perform? Second, how are short-term prices and yields quoted? Third, who promises the cash flows? And where does the claim sit in the capital structure? Fourth, how does an index translate many securities into one performance measure? Fifth, how can a derivative reshape an existing exposure? These questions are connected. A yield cannot be evaluated without understanding the contract behind it, and a derivative cannot be evaluated without identifying the underlying asset, the obligation, and the way gains and losses are measured. Asset classes are more than product labels. Cash equivalents emphasize short maturity and liquidity, but they still expose investors to reinvestment, inflation, and sometimes credit risk. Fixed income securities promise contractual cash flows and have a maturity date, but their prices respond to interest rates and credit quality. Equity represents residual ownership, so dividends are not contractual, and the claim has no fixed maturity. Indexes are measurement systems built from securities and rules. Derivatives create payoffs linked to an underlying asset, rate, index, or commodity. The economic features, not the marketing name, determine how the instrument behaves. This matrix links each broad objective to an example instrument, a benefit, a trade-off, and a decision question. A liquidity instrument is useful because it can be converted to cash with limited friction, but it may offer a lower expected return. A bond offers contractual payments, but those payments depend on the issuer and the price can change before maturity. Equity offers residual participation in business growth, but outcomes are uncertain. A derivative can offset a defined exposure, but it adds contractual complexity and may introduce leverage. The final column in each row is the most important. Ask the question before choosing the product. The money market consists of short-term debt and funding instruments, usually with original maturities of 1 year or less. These contracts support cash management, working capital, reserve management, and securities financing. Their short maturities generally make their prices less sensitive to long-term interest rate changes, but they are not automatically risk-free. Credit quality varies by issuer. Liquidity can weaken during stress. Investors must compare quote conventions carefully, and borrowers may need to roll over funding repeatedly. The money market is therefore best understood as a network of short-term promises, not as a single low-risk product category. Treasury bills are short-term obligations of the United States Treasury. They are typically sold at a discount, so the investor pays less than face value and receives face value at maturity. In the example, an investor pays $9,875 and receives $10,000 90 days later. Treasury Direct currently lists regular bill terms of 4, 6, 8, 13, 17, 26, and 52 weeks. Bills are issued electronically, can be traded before maturity through a bank or broker, and are generally exempt from state and local income taxes, although federal income tax applies. A certificate of deposit is a time deposit issued by a bank or credit union. It usually pays stated interest and may impose a penalty for early withdrawal. At an FDIC-insured bank, deposit insurance can cover CDs up to the applicable limit, currently $250,000 per depositor per insured bank for each ownership category. Commercial paper is different. It is a short-term, usually unsecured corporate promise, often issued at a discount by large, creditworthy firms. The key lesson is that similar maturities do not create the same risk. Deposit insurance, issuer quality, marketability, and legal structure all matter. Bankers' acceptances developed as a way to support trade. A buyer authorizes a bank to make a future payment to a seller. When the bank accepts the time draft, the bank becomes responsible for payment, and the accepted draft can be sold in the market. Offshore U.S. dollar deposits are dollar-denominated deposits held outside the United States. They have historically been called eurodollars, even when the deposit is not in Europe. These instruments are less central for most individual investors, but they illustrate an important principle. Financial contracts are often designed to solve a specific funding, settlement, or credit problem. 3 concepts organize today's overnight funding market. Federal funds are unsecured loans of reserve balances between eligible institutions. A repurchase agreement, or repo, is economically a collateralized loan. One party receives cash and transfers securities with an agreement to repurchase them later. SOFR, the Secured Overnight Financing Rate, measures the broad cost of overnight borrowing collateralized by Treasury securities. The original chapter emphasized LIBOR. That benchmark has now ended, and SOFR has become the dominant U.S. dollar reference rate. This update matters because benchmark design influences loans, derivatives, floating rate securities, and valuation across the financial system. A haircut is the difference between the market value of collateral and the amount of cash advanced. Suppose securities worth $10 million support a repo with a 2% haircut. The cash lender advances $9.8 million. The remaining $200,000 creates a cushion against small changes in collateral value and transaction costs. At maturity, the cash borrower repays the cash plus repo interest and repurchases the securities. From the cash lender's perspective, the same transaction is called a reverse repo. Haircuts can change with collateral quality, volatility, liquidity, and counterparty risk. A money market fund is a mutual fund, not a bank deposit. Its shares are not protected by FDIC deposit insurance. In September 2008, the Reserve Primary Fund held Lehman Brothers commercial paper. After Lehman failed, the fund's net asset value fell to 97 cents per share, an event known as breaking the buck. Heavy redemption requests then contributed to stress in short-term funding markets. The episode demonstrates that a product can feel cash-like in normal conditions while still depending on the credit quality and liquidity of its assets. Stability is a design goal, not an unconditional guarantee. Money market instruments use several quoting conventions. One quote may divide the dollar gain by face value, while another divides by the amount actually invested. One may assume a 360-day year, while another uses 365 days. One may annualize with simple interest, while another compounds the holding period return. As a result, 2 instruments can both display 5%, even though their economic returns differ. The comparison rule is straightforward. Place all alternatives on the same denominator, day count basis, and compounding convention before deciding which yield is higher. The bank discount yield is a traditional treasury bill quote. It takes the face value minus the purchase price, divides by face value, and annualizes using a 360-day year. In our example, the dollar discount is $125. Dividing by the $10,000 face value gives 1.25% for 90 days. Multiplying by 360 divided by 90 produces a 5% bank discount yield. The convention is useful because it is standardized, but it is not the investor's return on the dollars actually paid. That is why we need a second measure. The bond equivalent yield corrects two features of the bank discount quote. It divides the gain by the amount actually invested, not by face value, and it uses a 365-day year. The same $125 gain is divided by $9,875 and then annualized over 90 days. The result is approximately 5.13%. This measure is more comparable to the simple annualized yield quoted on many coupon-bearing instruments. However, it still assumes simple annualization. It does not show the effect of reinvesting and compounding the return throughout the year. The effective annual yield begins with the actual holding period growth factor, face value divided by purchase price. It then compounds that growth factor over the number of comparable periods in a 365-day year. In this example, the 90-day holding period return is about 1.266%, and there are slightly more than 4 90-day periods in a year. Compounding produces an effective annual yield of about 5.23%. This measure is useful for comparing investments with different compounding patterns, but remember the assumption: each maturing investment must be reinvested at the same rate. The same 90-day Treasury bill produces 3 annualized yield numbers. The bank discount yield is 5%. The bond equivalent yield is about 5.13%. The effective annual yield is about 5.23%. Nothing about the bill's cash flows changed. Only the denominator, day count, and compounding rule changed. When comparing alternatives, first identify the quote convention. Second, convert all yields to a common basis. Third, remember that yield is only one dimension. Credit risk, liquidity, taxes, transaction costs, and reinvestment assumptions can be more important than a small difference in the annualized number. A bond is a debt contract. To analyze it, identify 4 elements. First, who is the issuer and what resources support payment? Second, what cash flows are promised? Fixed coupons, a discount payoff, or a floating rate? Third, when is principal due? Fourth, where does the claim sit in the capital structure, and can the issuer call the bond early? These terms create several risks. Market interest rates affect price. Credit quality affects the probability and timing of payment. Inflation changes purchasing power. Liquidity affects the cost of selling. Reinvestment and call features affect the return actually earned. Treasury notes currently mature in 2, 3, 5, 7, or 10 years. Treasury bonds mature in 20 or 30 years. Both pay fixed interest every 6 months and return principal at maturity. Treasury inflation-protected securities, or TIPS, mature in 5, 10, or 30 years. Their principal adjusts with the Consumer Price Index, and the fixed coupon rate is applied to the adjusted principal. At maturity, Treasury pays the greater of the inflation-adjusted principal or the original principal. TIPS reduce inflation risk in the contractual principal, but their market prices can still fall when real interest rates rise. A mortgage-backed security pools many mortgage loans and passes principal and interest payments through to investors. The guarantee and legal structure matter. Ginnie Mae securities carry the explicit full faith and credit of the United States government. Fannie Mae and Freddie Mac are government-sponsored enterprises that remain under Federal Housing Finance Agency conservatorship and Treasury support arrangements. Even when credit support is strong, mortgage investors face prepayment risk when borrowers refinance faster after rates fall, and extension risk when payments slow after rates rise. Those changing cash flow timings make mortgage-backed securities behave differently from a conventional bond with a fixed maturity schedule. Corporate bonds promise contractual payments, but the strength and priority of those promises vary. Secured or senior debt typically has a higher claim on assets than subordinated debt, while equity absorbs losses first and receives residual upside. Credit ratings and market analysis distinguish investment-grade bonds from below investment-grade bonds, but ratings are not guarantees. Many corporate bonds are callable, allowing the issuer to refinance when rates fall and forcing the investor to reinvest sooner. Covenants may restrict the issuer's actions. Liquidity and interest rate changes can also move the market price even when the issuer continues to pay as promised. Municipal bonds finance public operations and projects. General obligation bonds are supported by an issuer's general resources and taxing authority, although the precise legal pledge varies by jurisdiction. Revenue bonds depend on a specific source, such as tolls, utility charges, lease payments, or hospital revenue. Investors therefore analyze different data for each type. Municipal interest is often exempt from federal income tax and may also receive state or local tax benefits for eligible residents, but the exemption is not universal. The tax advantage can justify a lower stated yield, which is why investors use a tax-equivalent yield calculation. To compare a tax-exempt municipal bond with a taxable bond, divide the tax-exempt yield by 1 minus the investor's relevant marginal tax rate. A 4% municipal yield divided by 1 minus 32% equals approximately 5.88%. In this simplified example, a taxable bond yielding 5.5% would provide less after-tax income than the 4% municipal bond. The calculation is a screening tool, not a complete recommendation. Credit quality, maturity, call provisions, state taxes, alternative minimum tax treatment, transaction costs, and the investor's actual tax situation can change the result. Common stock represents residual ownership. Common shareholders typically have voting rights, may receive dividends, and participate in the company's upside after all senior claims are satisfied. Preferred stock sits above common equity for dividends and liquidation value, often with a fixed or formula-based dividend, but it usually offers less voting power and less upside. An American Depositary Receipt, or ADR, is a U.S. traded receipt representing shares of a foreign company. ADR securities can simplify access to foreign equity, but investors still face company, currency, country, disclosure, and depositary risks. The legal claim determines both priority and participation. A stock's total return has 2 parts, cash income and the change in market price. Suppose an investor buys a share for $50, receives a $1 dividend, and sells the share for $54 after 1 year. The dividend yield is 1 divided by 50, or 2%. The capital gain yield is 54 minus 50 divided by 50, or 8%. The total return is 10%. The formula also works when the price falls, producing a capital loss. Taxes, transaction costs, and the timing of cash flows are ignored here so that the basic decomposition remains clear. A market index turns many securities into a single performance measure. The result depends on 5 design choices. The index provider defines the eligible universe, selects constituents, assigns weights, maintains continuity through corporate actions and rebalancing, and chooses whether the reported return includes dividends. Indexes can summarize a market, benchmark a portfolio, support index funds, and serve as underlyings for derivatives. However, an index is not the market itself. It is a rule-based representation. Different rules can create different sector exposures, concentration levels, turnover, and performance, even when the indexes use many of the same securities. A price-weighted index gives more influence to securities with higher share prices. The Dow Jones Industrial Average is a 30-stock price-weighted index. A market cap-weighted index gives more influence to companies with larger market values, usually adjusted for shares available to public investors. The S&P 500 uses float-adjusted market capitalization. An equal-weighted index gives each constituent the same starting weight and must rebalance periodically to restore equality. The weighting method changes concentration, turnover, and sensitivity. It also changes what an investment in the index means economically. 1 share of each stock, $1 of each stock, or ownership proportional to company size. A price-weighted index begins by adding component prices and dividing by a divisor. Before a split, 3 stocks priced at $10, $50, and $140 produce an index level of 66.67 when the divisor is 3. If the $50 stock splits 2 for 1, its price becomes $25 even though investor wealth is unchanged. Using the old divisor would create a false index decline. The index provider therefore adjusts the divisor to about 2.625 so the level remains continuous. Divisor adjustments separate mechanical corporate actions from genuine market performance. Consider 3 companies with market values of $400 million, $8 billion, and $10 billion. If the smallest company rises 20%, a market cap weighted index increases by only about 0.43% because that company represents a small share of total market value. An equal weighted index rises by 6.67% because each company begins with 1/3 weight. If the largest company rises 20%, the market cap index rises about 10.87%, while the equal weight index still rises 6.67%. The weighting rule determines which economic story dominates the index. A derivative is a contract whose value depends on an underlying asset, rate, index, commodity, or event. Derivatives can serve several purposes. A hedge reduces an existing exposure, such as locking in an input cost or protecting a portfolio against a market decline. Speculation creates a directional exposure that did not previously exist. Arbitrage seeks to profit from inconsistent prices across related markets. Structured payoffs combine contracts to create customized outcomes. The word derivative does not tell us whether the position is conservative or aggressive. Risk depends on the payoff shape, position size, leverage, collateral, liquidity, and the exposure held alongside the contract. An option buyer pays a premium for a right. A call gives the right to buy the underlying at the strike price. In this example, a call with a $105 strike costs $4, so the buyer's expiration break-even is $109. A put gives the right to sell. A put with a $95 strike and a $3 premium has an expiration break-even of $92. The long option buyer can choose not to exercise, so the premium is the maximum loss in these simple examples. The option writer receives the premium and accepts the obligation, which can create much larger losses. A futures contract creates obligations for both sides. The long agrees to buy the underlying under the contract terms, while the short agrees to sell. A firm that needs a commodity in the future may use a long hedge to reduce the risk of a price increase. A producer may use a short hedge to reduce the risk of a price decline. Futures are standardized by exchanges, and gains and losses are settled through margin. Most positions are closed with an offsetting trade before delivery, but the delivery mechanism helps connect futures prices to the cash market. Unlike an option buyer, a futures trader cannot simply walk away without closing the position. Pause and match each need to the most appropriate starting instrument. The 90-day cash need matches the treasury bill because maturity and liquidity align with the horizon. The 5-year contractual income goal matches a 5-year bond, subject to credit and price considerations. The long horizon growth goal matches diversified equity exposure because the investor can accept uncertain short-term outcomes in exchange for residual participation. The known fuel purchase matches a long futures hedge because the risk is a price increase before the purchase date. The purpose of the exercise is not to declare one product best. It is to align the contract with the risk and timing of the goal. Pause here and answer the 4 questions. Question 1 asks which instrument is a bank deposit rather than a marketable government or corporate security. Question 2 asks which yield compounds the holding period return. Question 3 asks what determines influence in a market cap weighted index. Question 4 asks for the defining right of a call option buyer. The correct answers are 1. B. A certificate of deposit. 2. C. The effective annual yield. 3. B. Larger company value. 4. A. The right to buy the underlying at the strike price. The chapter can be reduced to 6 durable ideas. Start with the job the money must perform. Read the quote convention before comparing yields. Identify the issuer, maturity, seniority, and tax treatment behind every fixed income promise. Separate a stock's dividend income from its price change. Treat an index as a rule-based measurement system whose weighting method shapes the result. Finally, map every derivative position by identifying the underlying, the rights and obligations, the position size, the collateral, and the exposure held alongside it. These habits turn a list of products into a coherent framework for valuation and risk management. You have completed asset classes and financial instruments. The next module will examine how securities are issued and traded and how investors measure risk and return. This redesigned deck reorganizes the original Chapter 2 material, updates market conventions such as Treasury bill terms and the replacement of LIBOR by SOFR, and replaces dated quote tables with reusable decision frameworks and worked examples. The speaker notes contain the complete narration transcript, review the examples in your own teaching voice, generate the audio with your private 11 Labs account, listen for pronunciation and pacing, and publish the final video together with the transcript and accessible PowerPoint.